perhaps our worst fears are beginning to turn out to be correct. We're not entirely surprised by the way things are turning out. We do hope that there will be a solution. But obviously, if the United States and Europe do go into a second recession, we can't predict the exact impact on world commodity and oil prices.
It seems tightening has done little to stem the tide of demand at the WDAS window of the central bank for dollars. Give us a sense of your thoughts on strategies for the MPC today with regards to managing the exchange rate.
On exchange rate strategy and imports, we have always said, and this is at the heart of our issue with the IMF actually, the exchange rate is not likely to significantly affect the quantum or the, of imports into the country because demand is inherently inelastic. I mean, if you move the naira to 200 naira to the dollar, it's not going to reduce the amount of petroleum products that you import and require. It just increases the cost of petroleum products. It won't reduce the availability of the quantum of manufacturing inputs and raw materials purchased by manufacturers. If it does, it only does that at the expense of capacity utilization and jobs. So the argument is not for me whether there is a cost, and I've always said this, you know, it is not a question of whether there is a cost or no cost to a stable exchange rate. But what you see, you just see the reserves. Okay, and that is a very apparent cost. Now, I could reduce the amount of dollars sold to the economy and create a scarcity of imported goods and a very high, very sharp increase in prices. Factories close down. That is a cost that you will not see on the reserves. So you build up the reserves by importing less. So our position is we will, so long as we have sufficient reserves to meet import requirements, we would rather have a stable exchange rate, okay, than allow it to go out of control. And we've seen that we're now seeing some slight accretion. The monthly inflows have moved up to about 4 billion, at least in the last 2 months. We don't know how sustainable that is. But if we're able to sustain that, then this becomes history.
Well, on the related topic, how much foreign investments are we seeing into the local bond market? You did allude to the fact that the increase in interest rates is also partly to draw some foreign interest into our local market to provide some supply of dollars.
I think the actual numbers, in fact, into the bond market alone, I think in the whole of last year, it was only, we had about $16 million out of the 5 billion that came in last year. Only 60 million went to the bond market. I think in this year we've had 36, a significant part of which came after we lifted the controls in July. Having said that, if you're a bond investor sitting in the UK, you look at the rates, you look at inflation, you look at security, you look at a whole range of other factors. I mean, interest rates obviously help attract investment. Other things have to be in place. And the point we keep making is that we have to keep working with fiscal authorities. We have to keep working with ministries to create an environment. You've got to address issues of security. You've got to address all the issues that lead to concerns about the general investment climate. And it goes beyond the rate of interest or the rate of exchange or the reserves. All of these are important, or the rate of inflation. They're important, but they're not the only things at this point in time. Secondly, the global environment itself is one in which investors are getting risk averse, in which investors are deleveraging. Now, by how much would an investor change his deleveraging strategy because of a 50 basis point increase in rates in an African country? I don't know. It depends on what that means to him in terms of return.
How are the nationalized banks doing today? Because on the street, there's a view that those institutions are struggling and there might be a need for them to do deals sooner than later.
Well, first of all, I don't like the word nationalized. These banks were recapitalized by AMCON. It's true AMCON is owned by the government, but there was no direct government acquisition of shares. and AMCON purchased bridge banks from NDIC. And from a legal perspective, it's extremely important to make the point that the exercise did not involve AMCON with any of the previous banks that have been taken over by NDIC. On the question of viability, the real issue the banks had was an issue of negative capital and high non-performing loans and very poor liquidity. And this has been solved. They've got capital, adequate capital. Their MPS have been taken over by AMCON, and the bonds given to them by AMCON are liquid in the sense that even while we continue to work out the deal structure in financial markets, at least there is a central bank window that they can always come to if they need liquidity. Now, you have a new management in place. We haven't yet constituted the entire board. We have a chairman. As is usual with institutions, they go through the process of rebranding, they understand the institution, and the reports I get suggest that they're doing very well. They've retained the customer base. Certainly there's no attrition. They are going out there looking for customers. I hear reports from customers. But you know, at this point, those banks are like any other Nigerian bank. The central, as far as we're concerned, Main Street Bank, Keystone Bank, we think of them like First Bank and GT Bank. They are now totally out of our hands.